The Singapore Depository Receipts, or SDR, gives Singapore investors a much simpler way to invest into some of the top companies from the Thailand and Hong Kong stock markets, such as Alibaba, Tencent, BYD, and so on. In this video, I'll be breaking down everything you need to know about SDR, such as what are they, how do they work, and most importantly, are there any downsides to investing through them? But before I start, do join my 10,000 members Telegram chat group to discuss or ask any questions that you may have. First up, what are SDRs? According to SGX, SDR are instruments representing beneficial interest in an underlying security listed on an overseas exchange. They are speaking the language of gods. But to put it simply, SDR allows you to buy foreign stocks on the Singapore Stock Exchange. Or basically, with SDR, you can now eat Hong Kong dim sum or Thai green curry right within Singapore. But why would you want to invest in SDR? Why not just invest in the actual stock itself? Here's why. So let's say you want to invest in BYD. One way you can do that is by searching for BYD in your trading app. Look for the one that's listed in the Hong Kong Stock Exchange, then buy the stock. However, here's where you run into one problem. Due to Hong Kong Stock Exchange weird trading rules, if you want to invest in BYD, you have to invest a minimum of 500 shares, which is equivalent to around 33,423 SGD. If you are Warren Buffett, can lah, 33k is easy peasy. But if you are a new investor, you have to save money by eating cai fan for the entire year before you can even come out with this amount of money. Meanwhile, with the SDR version of BYD, all you need to do is come out with just 672 SGD, which is way more affordable. So that's benefit number one. SDR not only lets you buy the stock that you want with a much lower cash outlay, but it also makes it easier to avoid over-concentration into one single stock. Second benefit, SDRs are denominated in the Singapore dollar, which makes things a lot simpler for investors. Because one, you won't have to purposely convert your money to a foreign currency just to trade the stocks. 2, you get to receive the dividends directly in SGD. And 3, if you are buying the SDRs via a broker that supports CDP, your SDRs will be custodized with CDP, which means the stocks are kept under your name and there's no risk to a broker default. Third benefit, trading SDRs instead of the actual shares itself can potentially help you to save on some fees. That's because you may incur lower brokerage fees when you are trading in the Singapore Stock Exchange versus overseas exchange. There's also no foreign exchange fees since the transactions are settled in SGD. Plus, you will also get to avoid foreign shares custody fees if you are trading using CDP brokers. Not to mention that some brokers like CMC Invest lets you invest in the Singapore stock markets for free for up to a certain number of times every month, thus allowing you to save on trading commissions. Fourth benefit, since the SDRs are traded on SGX, you won't have to worry about capital gains tax, since there's no capital gains tax in Singapore. Yay! Though, dividend tax is still applicable, depending on the country where the stock is originally listed in. For example, Thailand has a 10% dividend withholding tax, while Hong Kong doesn't tax dividends. Besides that, one minor benefit of SDRs is that since SGX trades between 9 AM to 5 PM, while the Hong Kong market trades between 9:30 AM to 4 PM, and both the Singapore and Hong Kong markets have different holidays, this gives investors the chance to position themselves ahead of the Hong Kong market. One example of this was during Alibaba's earnings announcement on 20th February 2025. So, what happened was that Alibaba announced their earnings results at 8:30 PM Hong Kong time. Then, on the next day, investors were able to quickly jump into the SDR from between 9 AM to 9:30 AM, right before the Hong Kong market opened. So, in a way, they were able to front-run investors who were trading the Hong Kong version of the stock. Though, I'm not saying that this will work all the time, yeah? Quick pause. If you are looking for the cheapest broker to start your investing journey, check out Interactive Brokers. It has the lowest fees for stocks, ETFs, options, and more. Not just that, Interactive Brokers lets you easily research stocks. Like, you want to check out companies' financials? Here it is. You want to check out analyst ratings? Here's a bunch of them. It even has free technical insights which tells you where the stock might possibly go next. So sign up to Interactive Brokers today, and let's get back to the video. So those are some of the main benefits of trading SDRs. But angkat bolas aside, I guess the biggest concern you might have is just how liquid are these SDRs are? Later, not much liquidity, the bid-ask spread will be very wide. Then, not worth it lor. Check this out. Here, I've listed all the SDRs for the Hong Kong stocks, as well as the Hong Kong counterparts. What you can see here is that the trading volume for the SDRs are in the tens of thousands, which is actually pretty healthy. Not to mention that as the awareness of SDR increases, the volume will slowly go up as well. Also, if you pay attention to the bid-ask spread of the SDRs, they all have a spread of around 1 to 2 cents, which means the bid-ask spread of SDRs are actually pretty good. Okay, then what about the risk of these SDRs getting delisted? Because not too long ago, the US was threatening to delist Chinese stocks that were trading on the exchange through ADRs. So could your SDRs be delisted and you end up losing money? Well, there's certainly the risk of the SDRs delisting, but what you need to know is that SDRs are legit investments which are recognized by both SGX and the overseas exchange. And each SDR is backed by the actual security itself listed on the overseas exchange, which is deposited with a custodian in the home market. So you can always choose to convert your SDR into the underlying stock by going through a conversion process. Though, just take note that you have to pay a small fee to perform this request. And if ever the SDRs are delisted for whatever reason, like if the exchanges feel that SDRs are not commercially viable and they decide to stop the program, since SDRs are backed by an underlying stock, they can just convert your SDRs into the actual stock or liquidate your holdings and return you the money. Whatever the case, just know that SDRs are safe lah, and you won't lose your investments overnight. So then, what are the actual downsides to SDRs? The biggest downside is that whenever there's dividends, there will be an up to 1% fee on the dividends. Though, personally, I think that this 1% fee isn't a deal breaker, especially if you are investing in more of the tech names like Xiaomi and Meituan, where there's no dividends. But I guess this 1% fee would be a bigger consideration when it comes to the dividend-paying names like HSBC and Bank of China, where the dividend yield can be 8% or more. In that case, what you can do is start investing with SDR first to build up your position. Then, once you have accumulated enough shares, you can sell your SDRs, then switch over to investing into the actual stocks itself. Besides the 1% fee on dividends, the second downside of investing in SDRs is that there's forex risk. That's because even though SDRs are denominated in SGD, the underlying is still denominated in their home currency. So for example, if the Hong Kong dollar strengthens against the Sing dollar, you might see both the SDR share price going down as well as the amount of dividends that you receive going down. Though, this forex risk exists whenever you invest in overseas investments, of course. And thirdly, by owning SDRs instead of the actual shares, you won't be entitled to any voting rights. Some people might find this to be a deal breaker, but I guess most people won't care about this too much. Lastly, if you are interested in investing in SDRs, let's talk about which are the best brokers to buy SDRs. As I've mentioned earlier, CMC Invest lets you invest in the SGS markets for free for up to a certain number of times each month. So, if you only invest in the Singapore stock markets once or twice a month, you can go with CMC Invest to save on trading commissions. Otherwise, the next cheaper broker to invest into the Singapore stock markets is Webull, which charges a total of 0.05% of the total trade amount and a minimum of $1.60. But if you prefer to use other low-cost brokers like Moomoo and Tiger Brokers, their commissions aren't too far off either. Though, just be aware that with Tiger Brokers, there will be a $2 custody fee per quarter, which can be waived. If you want to sign up to any of these brokers, you can use my links in the description below to get some sign-up rewards. So that was a quick video on SDRs. Hope you found it useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.